When NYU's Dean of Valuation speaks, investors listen. So when he recently updated his analysis of the so-called FANG-AM stocks, we wanted to know more. Joining me now, Stern School of Business Finance professor Aswath Damodaran. Aswath, thanks for coming on the show. Appreciate it.
Thank you for having me on.
So let's start with the big change in the economic backdrop that investors really need to adjust for: inflation and rising rates. What's your prediction for inflation over the next few years?
No, I think inflation, we've had a decade of low inflation, and I think it's over. I think we're heading into a period of higher inflation. The question is how much higher? If we settle in at about 3%, I think it's a benign scenario. If we go to 5%, then I think we're in trouble. But I don't think there's any question that inflation going forward is going to be much higher than it was in the last decade.
So in that scenario, you say that what investors ought to be looking for in a good investment is pricing power. Explain that.
Here's the simple reason. When interest rates go up, which is what happens when inflation goes up, you need to make a higher return on your stocks. So you used to settle for 8%, you're going to ask for 10%. The only way stocks can keep up in terms of delivering value is that they can increase their earnings and their revenues at roughly the same rate. Put simply, if you cannot pass inflation through to your customers, you're going to get squeezed as a company. So pricing power is going to give some companies the capacity to pass inflation through, and they're better bets when you have high inflation.
And a prime example of those stocks, one would be Amazon.
Yeah. To me, Amazon is the ultimate example of a company that has earned its pricing power. It's earned its pricing power by, in a sense, nurturing that pricing power for the last 20 years. It's built up what I call a disruption army, Amazon Prime, that is so heavily dependent on Prime that they essentially can charge higher prices and get away with it on much of what they do. They don't have complete pricing power, nobody does, but relative to other companies, I think Amazon is a great example of how you have pricing power.
And another one, of course, is Apple. My phone recently died, and only then did I realize how dependent I have become on that thing.
And it's two things. One is you're heavily dependent on your phone, and with Apple, the fact that they control the operating system basically means it becomes your area where you're comfortable. If you switch to a different phone or a phone in a different operating system, you feel lost. So again, I think if you look at Apple, they have the capacity to raise prices, and you're probably going to go along simply because you feel you have no choice.
So all of these companies, they're so big that they certainly face some threat of regulatory crackdown. In some cases, of course, those regulations actually help their incumbency status. But I want to ask you about Facebook, which almost seems to be begging for government action. Only the most recent scandal is this thing where they allegedly hired a consulting firm to spread falsehoods about TikTok, the teacher slap that really didn't exist. At what point does that company face some sort of a regulatory issue?
More than a regulatory issue, I think it's already run risks to its brand name and its capacity to keep growing. I think actions like these just put that company more at risk. I mean, I think all of these companies face the threat of regulation because I think they're so big that governments, in a sense, want to get them back, want to restrain them. And I think Facebook has not made any friends for itself. Across the last few years, everybody on pretty much every side of the political spectrum looks at Facebook and wants to stop it. And that's not a good place for any company to be, because when the regulations start getting written, nobody's going to come to your defense.
Yeah, that's certainly true. Finally, Netflix. Obviously dominant, missed out on that best picture, spending an awful lot of money to get that content. How do you see that working out?
The picture that comes to my mind when I think of Netflix is a hamster wheel. It's a company that spent its entire life putting out a model where it goes to the market and says, look, we can keep adding to users. And it's done that very well. It's a user-creating machine. But the way it adds users is by delivering more and more content. And especially in today's day and age, when Netflix is growing in 15 different countries, that content has to be in 15 different languages. I mean, for the last few years, the problem that Netflix has had is while its user base has grown, while its revenues have grown, its costs have kept growing too, its content costs. Unless it finds a way to get those content costs under control, and it's not going to be easy, it's going to have trouble in maintaining this model.
But it certainly does seem to be able to raise prices and crack down on passwords, and that'll help it on the revenue side. Aswath, thank you. Love your insights.
Thank you.